Okay, hello everyone. Welcome to our video with Jack and Jordan from OKC. So today we'll be talking more about crypto, the basics of crypto, and what's been happening in the past 2022. Plus, we'll talk about the future and what the future holds for the crypto space. So welcome, Jack. Welcome, Jordan. Nice to see you guys here.
Very good to see you. Thanks for having me.
Thanks for having me, James.
Yeah, absolutely. So let's get started. Crypto has been pretty crazy, right? I mean, 2022 has been pretty hectic, I would say. Let's look back at 2021. It was totally different scenario with the bull market and all, So, but before we get started with the events in 2022, let's go back to the history of crypto. I mean, why it was, I would say, discovered or created, and what principles it had for the people, and all that stuff. So, Jack, do you want to give me your thoughts on the history of crypto and the purpose of cryptocurrencies and all that?
Well, I'm hardly an expert and hardly a historian, but from what I understand is that the Bitcoin came to be from 2008 2009 financial crisis. So basically, what happened is that there was a lot of financial instability, and obviously people lost a lot of money on the stock market. There was also issues with the liquidity of the cash, and Satoshi, whoever that is, decided that it's best to have some sort of digital asset that you can use and have self-custody of without relying on any sort of intermediary or counterparty. So a counterparty or an intermediary or a middleman is somebody who handles your money and you're using them to move money around. So when that middleman fails, now you can't get your money back at all, or maybe just things get very slow and you have to wait a week or maybe a couple of months, or you're having issues with transmission of the money and there's all this kind of liquidity crunch. And so Bitcoin and crypto and blockchain was designed to bypass the ability to transmit the digital assets seamlessly without any sort of middleman. So that's what I would call one of the first principles of crypto. In first principles of crypto, the way that I understand it, it's self-custody, obviously transparency, something that you can audit, as well as trust through consensus. Consensus is the peer-to-peer network agreeing that whatever you have done is actually valid, and you cannot double spend the money that you have in your wallet, for example. So those are the first principles that were aimed to solve the issues that came about from 2008, 2009 liquidity crunch and financial crisis.
Yeah, you're absolutely right. I mean, especially with transparency, that was something that was lacking from the I would say traditional finance space, because there are too many things going on and people do not really understand how or why these things are going on. And because of the crisis, it was really, I would say, the breaking point. And the with the invention of cryptocurrency, I think it was something that really gave people the freedom of finance, the freedom of choosing financial services. And cryptocurrency has become very, very important. Jordan, what do you think? What is the importance of cryptocurrency?
Okay, so I believe cryptocurrency plays a huge role in our future. Fast forward to today, after Jack has mentioned a little bit about Bitcoin and the purpose of cryptocurrency. We're in an ironic state right now where we have centralized exchanges and decentralized exchanges. And for centralized exchanges, with the current implosion of FTX and the regulations that come alongside with it, it's a little bit ironic to say that, more regulation is needed. At the end of the day, Bitcoin was created so that the event that happened in 08, 01, 09 wouldn't happen again. So we are in this ironic state that I feel that at this point in time, users, retail investors, or even institutional investors should pick a side, because these two sides should coexist, but they should not cross boundaries. They should not cross too many boundaries that it becomes a regulated or non-regulated entity that helps to serve the space, because both centralized exchanges and decentralized exchanges have their own roles within the space. And at this point of time with FTX, it shows the same failure that happened several years back.
Several years back, do you mean like Bitfinex? I think Bitfinex was.
I'm talking about a traditional world where Jack also mentioned that there's this middleman. So this middleman in this case would be a centralized exchange. Yeah.
Yeah. Speaking of Bitfinex, I think it happened over 4 or 5 years ago, right? And I think it was also due to centralized exchanges being, I would say, unregulated, and that really create a huge problem, and that also shake the confidence of the investors in the cryptocurrency. So why do you
Correct.
think it, like that time we didn't have so many calls for regulations on the centralized exchanges, and so many calls for that take the sides of the decentralized exchanges?
I guess most of them, or rather the regulators probably don't think that it is such a big deal, and they want to see how the crypto space would really form before it came to what it is today. Back then, it was all about sometimes it's about memes. Last time there were ICOs, things weren't regulated. I believe the regulators are keeping an eye, but the problem here is that they always have to play the catch-up game, because they can't be the one leading the space. Unfortunately, that is kind of the state of cryptocurrency, where regulations will only come after, and even more unfortunately, that sometimes they have to be learned in blood, which is something that would get people not really very interested in the space, due to the main fact that it is such a volatile industry. But being a volatile industry also have its perks. You can many things are created, many technologies, many innovations are created due to this volatility, especially in technology, and also price points, right? These all factor into the main fact that it is today.
Jack, do you think these unfortunate events, I would say, in the past that happened in the cryptocurrency, do you think they led to better innovations in the crypto?
Well, there's definitely always better innovation, but I think what's really important right now is we're discovering the proper language how to describe the industry. And when we talk about regulation, I am technically not against regulation. And let me give you a good example. So let's say that somebody offers a stable coin. Now, in the completely unregulated market, if you offer a stable coin product that gives you yield or something else, you kind of expect the coin to be stable, obviously, because this is called stable coin. Now, the financial instrument that makes the coin stable could be completely not at all stable at all in general. Like, for example, Luna. Luna was backing up USDT, or I'm sorry, UST, and a lot of people felt that it was safe and was marketed as safe, and yet it was subject to a potential financial stress and potential attack, like somebody would short Luna and push it over the cliff, and then your stable coin is no longer become stable. Now, generally, when a product like this is presented to the market, there are other entities that end up building other products on top of you. So like, for example, let's say that there's a portfolio of stable coins that's generating yield for you, and it's a completely third party. They just include UST into the portfolio. And so now they could be also not regulated, but they level up the, I guess, the level of trust to the rest of the population, saying, by the way, not only it's everything is stable, but it's a portfolio of stable coins, therefore you're actually limiting your risk. And they're somewhat right that if you have a mix of things and things are called stable, then things should be more stable. But in reality, what may happen is that you may end up having a contagion effect where something fails and somebody is lending digital currency or digital credit to someone else, everything just unravels and falls apart. Now, when it comes to regulation, let me give you a concrete example, USDC. Now, USDC is an American company that's been audited by American auditors. Now, of course, one could argue that USDC have admin keys and they can turn off your crypto anytime they want, which is not technically the true decentralization that we aim for. But at the same time, the regulation could actually mean that anything that is labeled stable actually have some sort of rules before you can announce that you have a stable coin product. So I think the idea of the regulation could be viewed in a positive light when it protects the users and the consumers of the product from the advertising language that the producers of the product are using. So that's kind of like what I think about regulation at this, in this light.
Another thing that I always kept wondering was how the regulation in traditional finance works and whether it will be the same in decentralized cryptocurrency or in Web3 in general. Because like if I look at the traditional finance, the regulation kind of favors the banks or big financial institutions. And of course, there is a certain degree of protection that's given to the consumers. But in the end of the day, we can see that big traditional companies or the banks and all that, they are more protected when it comes to regulations and all that. So if we are going to have regulations in Web3, in crypto, are we going to see the same? Or is it going to be more focused on the end users?
Well, I think both sides need to be protected one way or the other. But I don't disagree with certain things. Like, for example, I'm in Hawaii right now and I cannot use Coinbase because Hawaii specifically protects, I guess, their residents from using crypto. And I don't think that's right. Now, Coinbase is an American company, but I could go to MEXC or KuCoin and I don't even have to give them my KYC at all. So what is the purpose of protecting me from Coinbase, that is supposed to be an American company that's very, very nicely audited, has the board of directors, have the shares, is traded on NASDAQ, and yet they're technically forcing me to, should I decide to go to the centralized exchange, to use something like MEXC or KuCoin, where there is no jurisdiction in terms of consumer protection. So that is the negative part.
So here comes the ironic part. You're saying that you can use other exchanges without submitting KYCs, and you can just use them as normal. And that's number one. And number two is like, okay, if you are a Hawaiian resident, then you cannot use Coinbase. But at the same time, you can use some type of VPN or any other type of things where it gets your IP to another location where Coinbase is available, and you can use it just like other people, right? So how does the regulation work, and whether regulation here comes, whether the regulation gives benefit to the users, or does it only, create some sort of inconveniences for the people?
Well, I guess all I'm saying is that there's a barrier to entry that is easily circumvented, and I totally agree with you. So it is circumvented with VPN, but what's happening here is that rather than making things safer on its own baseline, what I am protected against is ability to use my internet provider without VPN. But at the same time, I'm not protected at all. So this is a band-aid on a bigger problem. And the question is, why is that in Texas and California, I can use Coinbase, but not in Hawaii? So to me, it's just annoying. But to the other type of people who don't feel like using VPN, that's just making them actually needing to go abroad to unregulated exchanges that may be good or bad actors, we don't know. But for the sake of arguments, so FTX, for example, everybody talked about how FTX is so nice, and Kevin O'Leary on CNBC was saying, I'm a paid representative of FTX. And of course, a lot of people looking at CNBC saying, yeah, that is the one to use. And yet, with all of the regulation talk, nobody was truly protected and nobody has done due diligence on that company. And that's quite interesting. Now, I would say that obviously FTX.com would redirect American users to FTX.us, and there was really nothing that you could do on FTX.us. But the problem is that FTX.us is definitely, I guess, a subsidiary product of FTX.com. And so if FTX.com fails, everything else fails too. So you're not really truly protected. So all of that, I guess, dog and pony show about having a company in Bahamas and redirecting users to FTX.us is really just, again, for the show. It is not true regulation. It is not true protection. It's just basically complying with the rules and laws that are not really aimed at the consumer protection, but it feels like they get their points for enforcing the rules, and then they're saying, oh, you know, technology is complicated, we can't do everything. But in reality, what they were missing is simply asking a question. Does FTX have a CPA? No. Does FTX has a board of directors? No. Should it maybe raise some red flags? Well, no one asked. And that is the bigger problem than blocking me and my Hawaiian IP from using them.
Yeah, unfortunately, this FTX situation was really really big, and it really impacted the whole crypto space, which we're gonna talk after a little bit more. But I want to touch on Singapore, Jordan. So just wanted to ask the regulations in Singapore market and whether the government is actually doing something different than the regulators in the US.
Okay, so in terms of Singapore, what we're trying to do right now is have a lot more regulation. So if you were to put a scale of what we have here versus the States or some other countries that are trying to regulate crypto as well, everybody has a different yardstick as to where do that legality, or rather that regulation goes to. And Singapore is one of the strictest one. Even right now, we have only awarded less than 20 licenses to any crypto provider in the space. And it is just testament to show how much regulation is needed in our space here to protect our users. But then again, so with what Jack mentioned in terms of the if I were to just want to go to a certain exchange to create my account there so that I can trade a lot easier with a lot more products, I could do that. Like it is easily available to anybody. But I guess what we're trying to do here, it is just to make sure that we are able to present this crypto case to the general public using the official licensees that have been regulated. But when you say regulation, it is just one word. It does contain several components to it, which even traditional world where they were to do audits, it happens on a yearly basis. It could not be done at a higher frequency to ensure compliance at every single point. And things are always made in such a way that the audits timing would always coincide with whatever is needed to show to the government that things are being done. But sadly, that's not the case for so-called regulated products. So I think the key here is to understand that regulation is not the answer, but regulation is at best an assistance to your investment journey, where whether it can be making it safe or whether it can be making it to increase the types of products that you can use on each centralized exchanges. At least for in Singapore right now, the amount of products are very little. It's pretty much you can only trade, as far as I know, the exchange with the most number of cryptocurrencies are less than 20 cryptocurrencies in the exchange. Even OKCoin, also another subsidiary of the OK group, we only have 3 cryptocurrencies to trade: Bitcoin, Ethereum, and Litecoin. So you can clearly see that we are taking very minimal steps, at the least as a country, to push this forward. The regulation doesn't only stop at the cryptocurrency, the crypto exchange itself. It also goes all the way towards the coins. You probably wouldn't find a meme coin on a cryptocurrency exchange in Singapore. That's what I'm trying to say.
Does it make it, I mean, is it good or bad? In general, what's
Is
your
it
point
good or
of view?
bad?
Yeah, I mean, governments being very, very strict about the exchanges and the coins and all that. Do you think it's good
I
or
think
bad?
it's very different for everybody because everybody has a different risk appetite. My risk appetite is definitely higher, but for someone who maybe does not know about technology, who does not have the education in terms of the space, probably will feel very disgruntled and probably turned off by the fact that a cryptocurrency exchange like FTX has fallen. To them, it's just if they have not been in the space before, it's just like watching Lehman Brothers fall in 2008, but have nothing to do with it because they are not part of this financial system yet, this asset class just yet. But if they have been inducted, and then things will hit a lot differently, which is why we want to make sure that the bulk of the general public, I don't speak on the behalf of of the government, but I believe this is the direction we are going. We are always one step behind, but we make very concerted effort. Let's just put one scenario. A lot of crypto companies, big firms, are all coming to Singapore for setting up of their company, but the operation of the company might reside somewhere else. Technically, I mean, I would say it's because of our lower taxes as compared to many places in the world. But the operation itself, they always go somewhere else. And if they want to operate in Singapore, it may not be the best place right now because the licenses are not given readily. Even Binance was rejected of this claim of this license in Singapore.
Yeah, maybe regulation, this type of strict regulations are good for the general public who are less risk tolerant. And you guys have mentioned FTX a few more times, and let's jump into this topic. And so we had FTX situation, and before that we had Luna. So the first question is, was the lack of regulation the direct cause of these events? What do you guys think?
Jack, you want to go ahead first?
Sure. So I don't think it was the lack of regulation that would have saved it. But the problem is that we're all talking about regulations. Like as a concept, we can't even define it yet, or at least I don't see people who are making the laws are able to define it properly. So if we can't define properly what the regulation is, then how can we apply it? So for example, with the Luna situation, again, it was a stable coin that I feel like was just used for marketing to get people in. And so regulation could be about proper marketing. Regulation could be about proper operations, access to markets, leverage, everything. So all of those things need to be decided and figured out. And so that it's a complex issue, very complex.
Go ahead, Jordan.
Okay. Yeah. So I think the key here is to understand that at this point of time, we are still not mature as a industry just yet. We're still very much in our early stages, which is why education is key to letting public know about us. It should go down to the extent of governmental education for it's just like how in school you learn accounting, in school you learn about finance, you learn about how money works. That should be baked into at some point it should be baked into us to understand this alternate financial system as well. Because believe it or not, this will always be part of our future. Because maybe sometimes certain retail stores, going from offline all the way to online, all the way to the blockchain. This is pretty much how we can ensure the benefits of crypto flows in, and at the same time, the education of the public matches that level of Bitcoin knowledge. Sorry, not Bitcoin knowledge, blockchain knowledge or cryptocurrency knowledge. That's where I feel that a lot of the governments right now, at least for the regulators, might not have grappled with the fact just yet that the reason why all of this happening is probably not because of regulation. They need to treat the root of the problem, which is education. I would, if let's say I'm a user and I'm a user and I understand the risk that comes when investing in FTX.com, or rather in FTX.com. I would know that, okay, this is the risk level that I am accepting. There are all of these risks that is involved, including a bank run, all these kind of things. And the trust is as good as what you choose to trust the government / the company founders, because this is a centralized entity at the end of the day. So when we talk about decentralized world, not your keys, not your wallet, not your keys, not your funds, right? So pretty much that is summing up, even if they put this one sentence, right? Not your keys, not your funds, into the educational system. Or I don't want to go too deep into the educational system, but into educating the public, that would make wonders to millions of people, because that just let them know that, okay, if a cryptocurrency exchange, the wallets that belong inside the cryptocurrency exchange does not belong to you because you do not have the keys, the keys are held by them, they would know that, okay, I am accepting the risk that these funds are not in my wallet. But that is also the case with many of the banks, traditional banks, traditional insurers, traditional fund managers. These are all the same as this centralized exchange. Yeah, so at the end of the day, I feel that education is key.
Yeah, at the same time, few things, if we were to talk about banks and centralized authorities, and anytime anybody runs a company, they're not necessarily decentralized. They're just using crypto for exchange or creation of products, or they become a custodian for your crypto. So that is the way to explain it. Like a lot of people that if I tell them not your keys, not your coins, they won't even understand what I'm talking about. But they do understand they understand the idea of custodians. Like, for example, I have certain rights to certain assets that my custodians are holding for me. Now that's the traditional world. And generally, I expect those custodians to be completely legitimate, be audited, and be supported by the governments should they start to fail. Like, for example, back in 2008, we had this saying, too big to fail. And I think it was, we were talking about the automotive industry, where the Ford and Chevy or Chevrolet and various other companies were too big to fail. We couldn't let them fail. Therefore, the government on the country level kept them safe. Now, that is not the same for crypto. When it comes to crypto, you can become the custodian of somebody's coins and nobody's going to bail you out. And at the same time, whether you're a good actor or a bad actor, nobody really knows, as we can see with FTX. Now, if we look at the decentralized world, if we look at things like Uniswap and Aave, like, why do I feel that Aave is okay? That is because it is decentralized to a point where the blockchain actually shows that the code is immutable, it's on chain, and many people have audited the code, and there's no way my money is going anywhere beyond the code. Nobody is handling it with their hands. It's really just the computer system. Now, that is the first principle of crypto, where the code actually governs the laws of how my money or how my economic energy or digital assets are handled. And just for the sake of argument, if in today's world we only had decentralized digital assets, it is very likely that the ones who were doing something unreasonable or were acting unsafe would have been discovered, because everything is on-chain and open source and can be audited. And so I don't see Aave, for example, failing. I don't see Uniswap failing. Of course, things can be hacked, but it's a different level. Right now, what we're experiencing is a financial hack. A financial hack is where somebody says, I am fully capitalized, but at the same time, all I'm doing is I'm printing digital tokens, trading 10% of those tokens on the market, and now I have 10x leveraged my purchasing power. So if FTX, for example, was buying everybody in the world with the tokens they did not have. And nobody could actually tell that this is the truth. Like, everybody thought that they actually had the money because it kind of looked like they did. But if they were on chain, or specifically on blockchain, and we could audit everything, all of the assets, then we could see that FTT is actually not worth that much. Now, Binance guys, they say that we can audit their assets on chain. Now, I haven't done it myself personally, but if CZ tweets about it, then perhaps a lot of people are looking whether he's saying the truth, and they can actually say, yes, it's the truth, or no, you're full of crap, it's not true, because the on-chain analysis shows something else entirely. So on-chain data does not lie to you. Generally, it's either that the people lie or people are just making mistakes. Now, the code generally cannot be changed, generally does not have admin keys, generally is immutable, but could be mutable, could have admin keys, and it could be less safe. But at least we'll be able to see it. So when we don't see those things for ourselves, then we're actually taking away the choice. Like, for example, when I put my money on FTX, my choice of custodianship is passed on and delegated to an FTX company that may or may not survive. Now, if I hold my keys and I hold my tokens on chain, then it is up to me whether I'm going to lose my password or not. So that is the main difference.
Yeah, I think from the events that happened with FTX and Luna and all that, is not your keys, not your fund, and it's one of the biggest lessons that we have learned. And that is really good, because people have started to really realizing that none of the centralized exchanges are too big to fail. They are going to fail one day, but it's just a matter of time. And that means that people have started moving their funds from centralized exchanges to decentralized exchanges, and they have started being, responsible for their own coins, for their own assets. which is probably a different nation. I would say a totally different notion from what we used to have before with traditional finance, uh, whether it's with banks or insurance or any other, because we blindsidedly trusted the banks with our money, and then we thought that they would not bail on us, or they would not, um, hack, or they would not lose our money. But since it's a different notion, probably it's taking more time for people to understand that not your keys, not your funds is something just, it's a very huge responsibility, number one. And number two is, it's the way that should be, that is the right way to do. Without that, it would be just impossible for you to, keep your assets safe, especially if you're having, I don't know, millions or billions of billions dollars worth of assets in the centralized exchange. So you need to be very, very careful, and you need to do your due diligence, whether it's with FTX or Binance or any other. And
Yeah, and
yeah,
and
go ahead,
sometimes
Jack.
sometimes you can't. I mean, you could say that I have done due diligence, and my due diligence was the fact that Kevin O'Leary talked about it on CNBC. Now that's my due diligence.
Yeah,
And I just happen to trust Kevin O'Leary because he's a billionaire and he's been in the industry and he is smarter than me. And so a million people who is watching CNBC actually feel like they have done due diligence. Now, one thing that I wanted to point out is that it is very natural for humanity in general to fall back to things that worked. And what worked for the last 200 years were the banks and the companies that were centrally controlled. And that type of hierarchical system generally worked okay because that is how our society is built. Like we if we don't have things that work well, then I don't expect to be on the street and feel safe. We kind of expect safety, and we also expect safety that a dollar is a dollar, or and a euro is an euro, and yen is a yen. Now with blockchain, things got a little bit different, and specifically, the first principles of blockchain were addressing the fact that sometimes during stressful situations, centrally controlled entities cannot do their job well. And so passing on the responsibility to the people to actually handle your assets, just the phrase "your keys, my keys, my coins" is actually very complicated. What if I lose my keys? Does it mean my coins are gone forever? Absolutely.
Okay, maybe it's more of assuming a different type of risk. I thought about this a few times. There is no perfect solution to this. Um, it's clearly quite hard to have a perfect solution to this because you mentioned that, what if you lose your keys, right? So that's another type of risk that you assume. And then there are services that help you, keep your keys, right? There are services that help you keep your keys for, perhaps your NFTs or something like that. And then, or sorry, not keep your keys, but they keep your NFT or they keep your crypto as part of a custodian kind of service as well. So that's another type of risk that you assume. So as a consumer, you have to be comfortable with the type of risk that you are assuming at a point of time.
Sure. So what I would say is that when I spoke to some of my friends and I asked them why would they use centralized exchanges like FTX or Coinbase, they said that because they trust them and they don't trust themselves in securing their passwords. Because if they lose their passwords, then the money is gone. If they get hacked and their password is easy to guess, their money is stolen. And so it's a very normal argument to expect people to behave that way, to basically feel safer when somebody who is in business of safeguarding assets to be safeguarding their assets. Now, I feel like this is just early technology still, so it's been about 10 years, but we're still somewhat early. The one way to secure your keys could be biometrics. Like, for example, my DNA. My DNA is unique. Why can't that be my seed phrase? And so if I just remember my PIN and my PIN is impossible to hack without my DNA or maybe some other element, then perhaps that would make it impossible to lose because you cannot lose yourself. So I think we're still early, and this technology is extremely promising, and I think that's the future, obviously. And I think anytime there is an adoption of new technology, we experience this thing called S-curve. And the beginning of an S is always the steepest, not just in the performance and the pump, so to speak, but also an ability to understand what you're dealing with. The amount of information that's new is coming at you at the exponential rate. Only when you're in the middle of an S-curve, things kind of flatten out and you start to understand exactly what things are and what you're doing and how to keep things safe, and technology gets there. I mean, until recently, I mean, when I say recently, I would say, I guess 6-7 years, we didn't even have hardware wallets that sign your transactions off your computer that could be hacked. And so that is also very, very new technology that people need to understand how to use.
Yeah,
and like another
yeah, go ahead,
another
go ahead, Jack.
Another thing that's really interesting. So a lot of people think that their crypto is inside their wallets, which is not. Their crypto is on chain, and they have keys to the digital locker that exists on chain, and it exists somewhere on everybody's nodes or everybody's computers that's securing the chain. Now that concept is almost from the future. Like, how can I carry access to my funds that live elsewhere and have an ability to transfer them to you just by signing with something that is not even touching my computer? Now that concept, like that simple sentence that I have just pronounced, is very difficult for a lot of people to understand. And so, and especially for regulators. And I remember when they were the senators in the United States, they were, I guess, annoying Zuckerberg from Facebook. And they were asking him, so how do you not track all those people who are using your ads? You know, how do you make your money? So like literally 3 years ago, those people in the government, they didn't even know how Facebook worked. And if they don't know how the Facebook works, how do you think they can make decisions about crypto? Crypto is computer science, and not everyone is a computer scientist.
Unfortunately, that is the case, and it is very, very complicated than what we're seeing on the screens and what we think that we understand. And in the end, education, as Jordan and you have mentioned, is one of the pinpoints that we have to focus on, and we have to give all, because without education, it's just impossible for people to understand the risks, to understand how the whole crypto works, and whether there is whether this technology is something that they need to be using. And with the events that has happened, so are we in the bottom of the bear market, or do you guys expect anything that's worse than before will happen? What do you think?
So if there was an answer
ahead.
to that question, I would be a mega billionaire, right? Because I could time everything just precisely and use financial instruments to my advantage. Unfortunately, we do not know. My prediction, actually, I am more of an optimist, and I was a pessimist just 6 months ago, but today I'm an optimist. What I'm seeing is that inflation is getting better in terms of it's actually slowing down. So whatever the Federal Reserve is doing is actually working. I think this bear market is not going to be as intense as predicted. And generally, bear markets are intense in terms of financial stress, but they're not as long as the bull markets. So I think the best time to invest and to learn is specifically in the middle of the bear market. I think we're in the middle of a bear market. When you look at the assets out there, we're seeing things 80, 90, 95% down. Of course, anything that was up 1,000,000% probably was not really adequately priced, because we didn't know what the price of the dollar was. Like literally, we didn't know that our fiat currency is actually worth anything. And so people were dumping money into Rolex watches, homes, stocks, pretty much everything, and crypto, of course, too, right? Just buying everything. And everything was going up just because the fact is that dollars were simply printed out of thin air. Now, this is the COVID impact, and things like chain disruption around the world, and an ability to produce cars because the chip foundries were really got despecialized from making chips for cars and were making chips for consumer electronics because people are sitting at home and watching TVs and playing video games all day. So that type of stress obviously introduces all kinds of financial instabilities. But that's where the opportunities is actually to build something that works really well. And I think in any crisis, there is an opportunity. So I'm actually personally very excited.
So am I. I actually fully agree with you. I don't believe that the market will stay where it is for the longest time. Whenever my friends come to me or anybody asks me about where do you see the market going, um, pretty much I always tell them what goes down will come up, and that has been true for traditional markets as well. And typically, yes, bull markets are longer than bears. The main idea here is that you would like to predict the future, but you can't specifically do that. So when you are investing in crypto, you are investing in the industry as a whole. That is the very core of it. And there's a reason why many analysts and researchers or people that so-called predict what the financial markets will do. They told many people, the public at least, to allocate 5 to 10%. And that number has always been there since I would say many years ago. In fact, many years ago it was 5%. Now it's 5 to 10%. That's like the main value that I hear usually these few days. So I would say there's an uptick on the adoption of trying to invest in crypto. So I would say, yeah, I'm optimistic about the future as well.
Yeah, future is optimistic, of course, but the question, the billion-dollar question would be, when are we going to see a bright future? And when are we going to see the start of the bull market? Because as you guys said, like, we cannot really time the start of the bull market or the bottom of the bear market. But there is sometimes there is an event or a set of events that actually drives the market either upwards or downwards. So do you think we will have some sort of an event or a set of events in 2023 that would start the upwards, and then that would start the bull market?
December 5th. That's when the bull market may start.
Why is that?
Federal Reserve meeting.
Okay. Give us more.
Now, this is a binary question. Yeah. If Federal Reserve says things are looking up and we're only going to raise the interest rates by 0.5%, with the future expectation of 1/4 to 0.5%, that will actually cause the stock market to rally. Now, that rally in itself does not mean that you are now exiting the bear market and you're entering a bull market. Now, I actually don't believe in just the global bear market. I believe in different currents, and sometimes there are cross currents. So, for example, if you look at crypto, if you look at Ethereum specifically, it's actually been appreciating against Bitcoin. So if you plot Ethereum against Bitcoin, you will see that you would be like, if you shorted Bitcoin, the same amount of dollars that you would to buy Ethereum, you would be making good money, just because Ethereum is really winning. And Ethereum is winning because it's turning deflationary. So that type of new situation after Ethereum merge, and after I guess I have to say that the cryptocurrency that I helped to launch burned a lot of Ethereum, which is actually the case. It turned Ethereum to be more bullish versus Bitcoin. Now, that is actually technological achievement that Vitalik has presented with the Ethereum merge and the London fork. And that is the cross current that I'm really, really deeply watching. And what I'm thinking is that just like with stock market, a lot of tech stocks are depressed, 80, 90% down, maybe depressed too much. So anytime there is any sort of dovishness from the Fed, so they're not as hawkish as before, it will immediately cause what I would say, a release of a spring. So the spring coiled so tight with the depressed prices, and there's so much energy got compressed. It's just waiting for this immediate release. And I think if the Federal Reserve's action to remove liquidity from the market actually is working, and inflation is becoming more controlled, then that could actually move the prices of all on-risk assets much higher. When I say on-risk assets, I'm talking about something like, you know, Google, Microsoft, Nvidia, Netflix, all of the tech stocks, the obviously crypto. And crypto, because it's so new compared to the rest of the market, it has this thing called optionality. It's acting as an option on the global markets. So if something moves 10% on the global market, crypto may move 100%. And we see it. Like, for example, we're looking at Dogecoin, and Elon just released his notes for his company's meeting. And at the last slide actually shows payments for the Twitter users. Presumably, Twitter users could be sending payments to each other. Now, everybody knows that he loves Doge, and so Doge just rallied 15% just on those news alone. And that's very interesting. And I guess what I'm saying is that the opportunity is where we have the newest of the assets and the lowest liquidity. So even though Doge seems to be in top 10, only 5 million users actually hold Doge. And so if anything interesting happens within the Twitter universe, it immediately moves not just Doge, but all of the meme coins. And of course, once the meme coins are moving, you need Ethereum to buy them because you're trading them with gas. Ethereum is pushed also. And so everything connects. At this time, it connects across the positive element, not the negative. So we're talking about contagion sometimes when something fails, everything fails. In this case, everything could blow up just because people are actually putting their brains together and coming up with something that really works in this industry.
Really interesting point of view, really interesting inputs. Jordan.
Yeah.
So what do you think?
I think that well, you mentioned about memes, right? So meme coins are it's a very interesting thing that you have mentioned earlier on with Elon Musk, Twitter, and Dogecoin being its own you know meme in this case, right? I actually made a sharing session about Elon Musk and his grip on crypto in the recent times. And it's funny how you could make the association in between a tweet and the price of a token. That has never been so-called done at such a high level. Projects updates could give a bump to the token price and stuff like that. But this is a man's Twitter profile. And everything is linked to him being the face, the value, everything of the Doge community. Let's just put it to you in this way. The Dogecoin, or Doge Foundation and stuff like that, it's very hard to see pure adoption there. But that is kind of the culture where crypto is in terms of memes, meme coins. And where does this meme word come from? It comes from websites, traditional websites like 9gag, like what's that called? 4chan and stuff like that. So that's what meme is in the first place. So, and why was it named as meme? Is because people take it as a joke, but not necessarily a joke that is not real. It is still real in its very own sense. Sometimes it may be dark humor. Sometimes it may be just a clear indication of what the actual life is, but people try to interpret it in a different manner. So the same thing goes with a meme coin as well. The storyline that it tells behind this meme coin is kind of where the value lies, and how does Elon Musk connect with it. That's where I think that it is very interesting. His grip on Twitter, his and there's also a term called crypto Twitter. So what happens the day when Twitter falls? Where does crypto go, right? At the end of the day, Twitter is centralized. It has went from a board of shareholders, directors, towards a privately owned company, Elon Musk, one person. So it has assumed the risk of that. Back to our earlier topic about assuming risk. Yeah. So I think it's really interesting, and we should keep our eye on this saga.
Well, it's a good thing that Twitter is not a centralized exchange, right?
Yeah, that's for sure. But soon, once they put that fungible portion into it, which they potentially could. Right now they have the $8 subscription, but what if one day they choose to have, a token of themselves, just like Telegram has done, and Telegram lives, crypto lives on Telegram as much as, very much like Twitter as well.
Yeah, absolutely. With the set of events that are going to happen very soon, probably, I'm not saying it's 100% sure, but probably, yeah, we're going to see the start of the bull market. But funny thing is, no one knows, or at least a majority of people not know that it's the start of the bull market. And it may seem like a bull trap where they think that, okay, it's going up, but it will go down for sure really soon, and it's just a trap. And well, I hope it's not going to be the case, and I hope that the path forward in crypto space is bright for all of us, not only in terms of prices, but in terms of innovation, in terms of new technological uses, utilities, and all that. And I hope that 2023 would be one of the exciting years for the crypto space. And yeah, it will be nice to see what's going to happen in 2023. Yeah. And thank you guys for taking the time to come on to our video and give your thoughts. Very, very interesting points you guys have made. And it's something that we all need to take a good note of. And yeah, thank you very much, guys.
Thank you.
Thank you for the time.
All right.
Jack
Thank
and
you,
James.
guys. Thank you.
Have a good
All
day.
right.
Bye.
Take care. Bye-bye.
Bye.